A shipping container sits in a warehouse for 7 years, untouched, generating zero tax liability, and it's all perfectly legal. Most people assume that the moment goods cross a border, they're taxed, duties apply, tariffs kick in, the state collects. But that's only true if those goods enter the actual economy. There's a parallel system, a legal gray zone, where merchandise can exist in limbo indefinitely, owing nothing to anyone. Freeports and bonded warehouses are geographic or administrative spaces where import duties and sales taxes are suspended. A diamond merchant can store inventory in a freeport for years. A wine importer can hold stock in a bonded facility. No duty owed, no sales tax triggered. The goods exist in a kind of fiscal stasis, waiting for transaction that may never come, or waiting for the right moment to come. Historically, this made sense. A port city needed to attract traders. Suspending duties on goods in transit or temporary storage reduced friction, encouraged commerce, and built wealth. London, Singapore, Dubai all built freeport zones. The mechanism worked as intended. It lowered the cost of doing business and moved supply chains faster. But here's where the system fractured. As wealth concentrated and regulatory capture deepened, freeports became something else entirely: storage vaults for the ultra-wealthy. Art valued at millions sits in climate-controlled bonded warehouses in Geneva and New York, never triggering a sales tax because it's never technically sold domestically. The duty suspension, meant to facilitate trade, became a tool for indefinite tax deferral. The real mechanism isn't complex. A corporation imports goods into a bonded zone. They're held there. If they're re-exported, no duty was ever paid. If they're sold domestically, duty is owed, but only at the moment of release. This creates a window: hold indefinitely, defer indefinitely. For perishables, the window closes. For art, diamonds, and luxury goods, it never does. The implications are systemic. Governments lose revenue. The tax burden shifts to those who can't afford warehouses, small businesses, working people, wage earners. Meanwhile, the wealthy access a parallel financial infrastructure: duty-free storage, tax-deferred appreciation, and institutional anonymity. It's not evasion. It's the system working exactly as designed, but only for those who can afford the design. What makes this predictable isn't greed, it's incentive structure. When rules allow deferral, capital flows toward deferral. When storage is tax-free, goods migrate to storage. No conspiracy required. Just rational actors responding to rules written long before anyone imagined a $50 million painting sitting in a vault for 30 years. The system didn't collapse because it was never meant to prevent this. It was designed to enable it. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe for a weekly breakdown of the legal mechanisms the wealthy use to navigate the financial system, because understanding the rules is the first step to understanding who writes them. This video is for educational and informational purposes only and is not financial advice. Always do your own research.